stock markets are pulling back, tech is wobbling, and all of a sudden, geopolitical risk is back on the tables as there is threats to war and uncertainty over in different regions such as the Middle East. Now, is this the start of something bigger? Because just a few weeks back, maybe the start of January, volatility seemed to be easing out and there seemed to be a lot more clearer vision for the markets. But as we know, things can happen in a heartbeat, and we're starting to experience that volatility right now. So in this video, we'll be talking about what's actually fueling this pullback. We'll be talking about some earnings and the effects it's had on my portfolio specifically. We'll also be doing some live investing at the end, so you guys can see, again, I'm putting my money where my mouth is. So yeah, watch to the end of the video to see exactly what ETFs or stocks that I'm choosing moving forward. Over the last few weeks, global equities, specifically in the US, have been driven by three main points. The first point, resilient growth data, sticky inflation, and shifting expectations around interest rate cuts. And that last one is the key one that is really fueling the sentiment right now in global markets. Now, it's known that the Fed has paused the interest rate cut cycle to around 3.5 to 3.7%. And the reason for this is because inflation isn't cooling down as quickly as expected. Now, the reason this causes all this volatility is because equities like interest rate cuts, because the debt essentially becomes cheaper for these companies so they can borrow more and essentially spend more, right? But with the inflation, it's causing a roadblock, which is allowing the Fed not to cut the rates as quickly as they want. So you've probably seen maybe in the news, Trump really pushing for interest rate cuts, and Chair Powell is not having it essentially. So he's made it known that rates will not be cut and they'll be paused, which could be seen as more of a negative for the market. And because going into 2026, the expectation was that interest rates would be cut. So if you think about it, if they've just paused it, that essentially dampens the expectation because we didn't meet that standard. So as we've paused it, it doesn't look good. So there's naturally a lot of fear creeping into markets, and that causes the volatility because, you know, of the uncertainty that is around those specific points. But for me, there is a key point and a shift almost in mentality of global investors that doesn't happen very often. And that is the shift away from the US. We are literally seeing money being pulled out of US assets, particularly stock markets, and being redistributed into index funds based in the UK, Europe, DACH region, for example, as investors are seeing the US as a little bit more risky. The perceived risk is higher, mainly to do with what Trump is doing, and they are putting money into other perceived safer havens away from US assets. And we can see this practically. If we look at indexes like the DAX or the FTSE 100, we can see that they've had a positive start to the year relative to the S&P 500. So we can see the money, where the money is moving within the market. And as you know, I've been documenting the journey for a while, and all this volatility directly impacts my holdings because I have a lot of exposure into companies in the US and specific positions into Google, Amazon, Microsoft. So whenever there's chaos, whenever there's earnings, that directly impacts my performance. So let's show the portfolio and specifically those three companies that I mentioned there, because there were some positive earnings that have been released. Now guys, as we can see through the portfolio, we're sitting on just over 43k with a rate of return of 10.1%. And again, the volatility of the market hasn't had a great start as we expected from the expectations last year, but nevertheless, we're still surviving. We're still in the green, which is great. So guys, I want to focus on Amazon to begin with, because we did have you could say positive earnings, although that necessarily wasn't shared into the share price, which we'll be diving into. Now, Amazon's one of my stronger positions in the portfolio, and you're probably thinking, Kai, why is it a strong position? The share price on paper isn't doing well. And for me, it's simple. The financials and the earnings were positive. So revenue was up. We had growth in AWS and their advertising business, which is great. The only downside was that they spent a lot of money on AI investments, right? Actual infrastructure. And the thing is, with investors, they want to see a return almost straight away. And the return on those investments that they made will take a few years for us to see any real growth or dividends. So that is the reason why we saw the share price pull back. But again, I'm still very confident in Amazon as a position, and something, if anything, could be seen as a buying opportunity. But I'm not buying anything just yet. Happy to hold at my position, as we see we're pretty close to our entry point as well. Now, looking over at Google, although it's a small position on this portfolio, on my FreeTrade portfolio, it's a much larger position. So Google, again, done very, very well, beat earnings, beat revenue. You know, their cloud business is doing well, as well as their advertising business as well. We're seeing growth in many different areas, similar to Amazon. And the key bottleneck for this smaller pullback was literally AI spend and expectations. They've spent a lot of money on AI, and the whole question that investors are saying is, okay, are we going to get a return on this massive spend in AI? I think they will, just given how much reach Google has and how dominant they are within their space. And we're seeing, you know, their products like Gemini do very well at the moment. So again, it comes down to expectations and the amount of money that they're investing on themselves, which I think personally is a good thing. I do have in a separate portfolio is Microsoft, and I'll put a screenshot here of the position and how it is performing. Similar to the last two stocks that we discussed, we're also seeing a very large pullback in Microsoft, but it's something that doesn't concern me as much because we did have a strong earnings with Microsoft as well. It all comes down to the fear of how much money these companies are spending on AI and the fact they're not getting a return on that specific investment at the moment. But nevertheless, Microsoft could be seen as a buying opportunity. There are larger investors as well, large institutional investors that are buying up Microsoft as we see this pullback into the market. So I think there could be some real growth in Microsoft in the next, you know, either few years or the end of this year as well. So we are investing into the same ETFs that we have been back in January and as well as this month here. We're keeping it consistent, investing every single month and compounding our returns. And I think that's the great thing about investing, picking a figure that works for you, whether it be £10 a month, £100 a month, whether it be a percentage of how much you make for the month, whether you want to invest every 3 months, right? You can really tailor it to your goals and what you're working towards. So for me, it's monthly, and I stick to a figure each and every month that works for me. So we're sticking to those ETFs. We're not investing into any stocks yet. I'm pretty comfortable with the stocks that I have, and there is a lot of uncertainty into the market. So I'm not in a rush to buy any stocks quickly. I'd rather position myself into ETFs to reduce as much as risk as I can at this moment. But that is it for the video, guys. If you have been looking at any positions that I've discussed, let me know in the comments. I'll be really excited to see if you guys are also investing into stocks or ETFs as well. And leave me a like if you enjoyed this video. I'll see you on the next one.